The stock market absolutely loves to crash. It crashes all of the time, right? And it's actually completely normal. So what I want to do is make this video now while the stock market, the S&P 500 is near all-time highs. Like right now it's the 14th of January 2025. The price of the S&P 500 is $5,836. Now, it is completely normal for the market to crash. No one knows exactly when, but the reason why it crashes is because the market is a whole heap of participants, investors, right, buying and selling. So it has a lot to do with, if there's a lot of sellers, all of a sudden, the price keeps on falling. If there's a lot of buyers, all of a sudden, the price will go up. It is actually supply versus demand. So when, let's just say something falls by 20%, it could happen because of some bad news, but it might go further than what it actually should, because when something is down 20%, a whole heap of people are going to freak out, be like, wow, I just lost 20% of my money. I should maybe sell, because they're really, really scared. The fear sets in, and that happens in reverse as well. And that's how bubbles are created. Like if the price of something is up 20%, everybody's thinking, wow, I'm 20% richer. I need to buy more. They're not actually thinking rationally what is the true value of the asset they're buying. So the stock market and many many things in life, when you got the reason is because if you got your future on the line, if you got all your money wrapped up in this stuff, it can be very nerve-wracking because that is your life, right? But the biggest thing is it is completely normal, and we can use it to our advantage. Like, and you definitely don't want to mess up. Like, I do believe you should just be dollar cost averaging and not really worrying about this stuff. But what I want you to know is, a 50% crash on the S&P 500 every decade or so, and I don't know exactly when it's going to happen, is completely normal. So, yeah, stock market right now is at $5,836. If you're not really willing to go through a 50% crash, and you know yourself, like you're actually going to get scared, you have that self-awareness, you think you're going to get scared and you're going to sell, then that's fine. Choose a different asset, maybe like property or something that's better suited for you, because you can't sell your property really quick at a click of a button. So, that's a potential negative of the stock market, but for someone like myself, it's also a potential positive, because when the market's down, everybody's selling. You could be very opportunistic, come in at the lows and keep on buying. Stay with your dollar cost averaging strategy, and keep on buying and staying in there. So the way I want to word it is, right, it's like, let's go back to COVID, right? The market crashed pretty damn hard, and that's these candles here. Like over the course of like 4 weeks, it really moved down a lot, and it honestly was quite frightening, especially the COVID one, because we didn't really know what was happening. Unless you think you're an expert with viruses and all that stuff, you don't actually really know. But the biggest thing that I like to keep in mind is the best companies in the world, they're all in the US. The S&P 500 is the top 500 companies in the US, right? So it's like self-cleaning the S&P 500. It's going to cycle out the best, the worst companies and keep in the best. So imagine if a company gets worse, it's going to get kicked out of the bucket and will get automatically replaced with something better. So it's self-cleaning in that fashion. But also companies, they're also self-cleaning in another fashion, because imagine, who owns these companies? They are investors. They are the wealthy, right? If the wealthy have all their money tied up in these companies, that's how they became wealthy in the first place, and now they're down by 50%, they are going to do everything in their power to get the price of that asset back to the highs. They're not going to say, hey, my company is down 50%. Let's go on a 10-year holiday and do absolutely nothing, right? Or let's fire all the staff and let's just quit. They're not going to do that. They're going to go into reactive mode and really try and fix the situation and build back, right? So it's self-cleaning in those two ways, which I think is super, super important. Um, Now, the way I want to word this is, over the last few decades, the very best time, when was the very best time to invest in the S&P 500? When was it? It was during or at the lows of the 2008 financial crisis. So if we turn on these lines here, and you can see the 2008 financial crisis, The stock market fell by 55%. It crashed by 55%. Now, that sounds really bad. But is it correct in me saying that was the number one best opportunity to buy? Right? It was a great, great, great time to buy. Now, when we're presented with another opportunity like this, was also the 2020 COVID crash. It crashed extremely fast, and it really went down quickly. I think I accidentally deleted, but I think it's 38%, right? Roughly 38%. The market crashed in just a matter of weeks. Great opportunity, because if you bought there and just held for a few months, you made a big return, because if something falls, let's just double check it, like roughly here. Down is like 35%, all right? Then if you were to buy at these lows, obviously you can't time it, all right? But I'm just trying to prove a point here. When it returns back to the high, you're not up 35%, you're up 55%, okay? So it's really a great time to make a lot of money. Now, I did say, hey, it's the second best time was to buy the COVID crash. That's not necessarily correct, because, if you were a buyer anywhere in here, 2016, 2015, 2014, 13, 12, anyway, all the way till 2008, right? 2000 or 2009. The bottom was 2009 of the 2008 financial crisis. If you were bought anywhere between those dates, it was actually better than buying the COVID crash, right? But if you want to make that money quickly, coming in when the market is, everybody's scared, the market's crashed by a lot, you're actually going to get a big outsized return by doing the opposite of everyone else. Now, you can keep in mind, like, you can't do this with every single asset, but, something like the S&P 500, for, the time being, it makes sense. Like, if it were to crash 50% tomorrow, I'm definitely going to be a buyer, right? I definitely think the best companies are in the US. Now, let's keep in mind here, what did we say? The S&P 500 is a bucket. It is a bucket of 500 assets, which means it's actually extremely diversified, right? 500 assets within one asset. And even though it's so diversified, it still has the ability to go down by 55% in the case of the 2008 financial crisis. Now, just feel that. 500 different companies in one asset. A lot of people say it's risky. There's a difference, right? There's a difference between volatility, how far something goes up and down, how quickly that happens. That's volatility. There's a difference between risk. Risk means it goes down and it never comes back. You lost your money forever. So, like, a quick comparison is, like, a lot of people, they're more familiar with investing in property and real estate. A lot of people, they only have one house. They only have two houses. They only have three houses. It's only three. Three compared to 500 money-making machines, right? So which one is actually riskier, right? Maybe one is less volatile, but maybe potentially more risky. Who knows, right? Who knows? So it's just some food for thought. So I'm saying there's 500 companies, extremely diversified. So imagine you're in a singular stock, right? A singular stock you would actually expect is probably going to be more volatile than the S&P 500 itself, okay? So right now, as an example, I just want to put it out there. NVIDIA, another asset which is at the highs, right? It's at the highs right now. Price of NVIDIA is $133. And if we look at it, NVIDIA, it looks like there's roughly these two lines here. I've just drawn it in for the sake of it, like, roughly near the green line is probably roughly near where, it's probably the bottom of it. And the red is where historically it's been the top of it, right? And we are near the red right now. I don't know if it's going to go down. Who knows? What I do want to say is NVIDIA has the ability to fall by more than 50%. And if it does in the future, that does not mean NVIDIA is dead and it's game over. Just like the S&P 500, it has the ability to bounce back, and it's actually completely normal. And remember, if it's a singular stock, right, if it's a one company, it's probably going to be more volatile than the S&P 500 itself. So what I want to say is, if this asset, NVIDIA, dropped all the way to the green line, let's just say it moved like this from now down to here, okay? That's a 67% move. Based on the charts, based on history, based on everything that's ever happened with the stock market, a 67% decline is actually completely fine. So if you see yourself in this scenario, I would honestly seek advice and make sure you're making some good decisions. Often the best decision is literally to do nothing or to potentially buy more if you know you've got high quality assets. Please, 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 please do not be a seller at the lows because you're the sucker. I'm sorry, but that's the truth of it. You'll want to be a buyer. Now, um, I try my best to communicate all of this stuff. I'm an eToro popular investor, and if we just check, currently there's 211 people copying every move automatically that I make. There's 1.57 million US dollars that's copying everything that I do. Previously, before the most recent correction, so if we go back to the S&P 500, where was it? So yeah, before this correction, so after COVID, the market ran for all the way from the COVID lows of $2,200 all the way to the highs of 4,825. At the peak here, we actually had around 300 copiers. Now, those 300 copiers, they were mainly sticking and copying this whole time as the market corrected lower and lower and lower. Roughly right near the lows, 50% of the copiers left, right? 50% of the copiers left. I believe a lot of them did not come back. So they just locked in that loss. So, it was down 27%, the S&P 500. My personal portfolio, I think, was down around 38%. So down even more than that, which makes sense. Not as diversified as the S&P 500. It's more volatile. My portfolio is more volatile than the S&P 500, which also means when the market goes up, we should go up more than the S&P 500. And that's exactly what has been happening. So I just started after COVID, and the portfolio is up around 200% since then, right? It's beating the S&P 500 a lot over that time frame. So yeah, I just wanted to make this video now. While everything is looking really good, there's no negative news about the stock market and stocks, and Nvidia is like the god of the world currently at the moment. If the market crashes, please watch this video. It's not the end of the world. It's gonna probably come back, right? The S&P 500's coming back. I'm not sure if your individual stock's coming back, right? Most likely it is. But if it's a high quality stock, but the S&P 500, it's designed in such a genius way, it should be coming back. Now, if we go back to Nvidia for a second, and we take a look at it, right? The market, it loves to zigzag up and down, up and down, up and down. And if we look at my personal position in Nvidia, it's only 1.83%. So a very, very small percentage. So none of my investments are so big that they'll scare the living daylights out of me. They're all a reasonable size. But you can see it's up 413%. Okay. Now this thing can come down 70% again, and it's going to be absolutely fine. One of my regrets is when the market did correct down here, why did I not load up even harder? Like I should have loaded up way more than I did. Like, yeah, I'm up 400% on, but it's only a 1.83% position. Like, honestly, that is not good enough, right? It's actually not good enough. Like, so, being strict on myself, being honest with myself, should have loaded up even more. Yeah, but all this stuff is in hindsight. The beauty of it is every day we just keep showing up. The market is the market. The market's always usually correct in the long term. And if we play our cards right, we can make a very good living and become extremely wealthy from the stock market. So yeah, let's keep this in mind. S&P 500, every decade or so, I would say there's a high probability that it crashes by 40 to 60%, right? 40 to 60% is absolutely normal. Individual stocks, potentially even more than that. It's completely normal. Please, please, please don't be a seller at the lows. You actually want to be a buyer. Buy more. And so what, because I'm doing dollar cost averaging, I'm just buying as much as I possibly can every month. So these fluctuations, they don't really matter. So that's why I was saying, like, if we go back to the S&P 500, yeah, I said the COVID crash was the second best time to buy. It actually wasn't, right? It actually wasn't. Any time before that, 2016 to 2009 was actually better, right? You actually made more money. So when this happens again in the future, please just be a buyer. Keep on buying. And when the market comes down to lows, what do? You may want to consider sacrificing even more and increasing your dollar cost averaging. You don't want to try and wait for the absolute lows because no one knows when the absolute low is. At that time when that happens, there is probably people that are trying to sell you on, I'm going to sell you some course, or I'm going to tell you which stocks are at the lows, and they're going to have some sort of, online community where you have to pay a monthly subscription to get these calls. That's all BS. No one knows where the low is. You just got to be dollar costing. So the best thing to do is just sacrifice a little bit more. Understand the most crashes, they're normally done within a year or so. 2 years is absolutely pushing it. But if you sacrifice really hard until it's over and the market reaches a new high, and when the market breaks out to a new high, so let's just say, like, as an example, the market was at a high here, it crashed for a while, it climbed, and then made a new high, you're really, really set. It's once the market makes a new high after like a year or so, the odds that the market ever goes below that level is extremely low. Why? Because everyone in the history of that asset, if they did not sell, is now in a profit, right? If someone is in a profit, what is their face going to look like? It's going to have a big smile, right? They're going to be nice and happy. When someone is nice and happy, what are they likely to do? Keep on doing what they did in the first place because they had a positive reinforcement. So what are they going to do? They're going to be a buyer. When there's more buyers coming in, it's going to support the price, and the price of the asset is going to keep on going higher, right? It's as simple as that. Supply versus demand. All right. And that's everything for the video. Just want to get prepared. I'm not saying the market's going to crash right now. I want to prepare for the next 10 years or so. And when the market does crash, please go back and watch this video. And I want to make this now, so when it does happen, I don't have to make the video on the spot. I can just copy, the link and send it to whoever needs it. All right. Thank you very much. Stay safe out there. And remember, it's a big, big, big lesson.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in? No?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.